Coming up next on Morning Call, shares of Yahoo moving a little bit lower this morning. The stock is already up more than 46% in the last 6 months. We're going to speak to the company's CFO, Susan Decker, when Morning Call comes right back. All right, welcome back, everybody. The Dow is up 76 points this morning, and let's take a look at shares of Yahoo, which have been under some pressure today. Down about $1.15 right now at $18.43. This despite news that the web portal posted better than expected earnings last night after the bell. Joining us to go over the numbers is Susan Decker, Chief Financial Officer of Yahoo, from her company's headquarters in Sunnyvale, California. Susan Decker, good to have you with us.
Thank you, Martha. It's great to be here.
You know, obviously the stock is backing off a little bit this morning. I'm sure you're well aware of that. Why do you think that the market has reacted a little bit negatively to these numbers, which you feel are pretty good?
Hey, you know, we try not to worry about the day-to-day movements in the stock price. You never know what's expected versus what's delivered. What we really try to focus on is what we can control, and that's the plan that we outlined more than a year ago. And we feel like the numbers yesterday, the numbers for the quarter, for the year, no matter which line you look at, revenue, EBITDA, free cash flow, really demonstrate validation that the plan is working.
One of the numbers that jumped out to me when I was looking through them is this average revenue per user number, because I know that you all have been focusing on trying to raise the paid services component to sort of diminish your emphasis on advertising in terms of what Yahoo relies on. 46 cents average revenue per user, up from 42 cents. Is that a number that you're satisfied with, and where would you like to see that number go, say, next quarter?
Sure. Yes, I think revenue per user is a really important measure to us because it really reflects the value we're delivering to our consumers. We said a while ago that the goal was really to develop very innovative products and services for consumers, and if we can do that, they're going to keep coming back, which will translate well into our business model. So in terms of the 46 cents per month per user, we're very satisfied with that number at this time, but we think that's just Act 1. We actually think there's a lot of further progress in that number. We actually outlined a year ago that we hoped we could double our revenue per user from a 35-cent level in 2001 over a period of 3 to 5 years. So we feel like this demonstrates good progress against that goal, but we still think there's a lot to come.
So you're shooting for 70 cents over the next couple of years for that number?
We think that 70 cents is very achievable within a 2 to 4 year time frame.
What about tell me about gross margins and operating margin improvements. There were some nice moves there as well. Where do you think that to what do you attribute that? Which part of the business plan that you've been implementing do you think is really paying off for you?
You know, our margin story is a very favorable one, and I think it really speaks to the whole business model. You start at the top line with very balanced and strong and diverse revenue growth. Our incremental costs to drive that revenue are very low in terms of variable costs. So really, of every incremental dollar of revenue that we drive, roughly 70 cents fell to the EBITDA and profitability lines this year. And as you look forward, we expect a similar performance.
What about the stock? I know you said you don't like to follow the day-to-day movements of the stock, but clearly you're beholden to shareholders as well. And the argument here from analysts, Credit Suisse First Boston's Heath Terry downgraded the stock today. He took it to an underperform. He said the valuation looks stretched here, and that's something that we've heard a lot about Yahoo stock over the past few months as it has started to rebound quite nicely. It's trading at 78 times 03 earnings right now.
We're always amused by the day-to-day movements in ratings up or down. If it was expensive today, after he raised numbers, we wonder what they were thinking yesterday. But I think more broadly, the point is that we really feel value is driven by growing free cash flow. Our free cash flow is actually higher than our EBITDA last year. It's double our earnings. For most companies, free cash flow is actually less than their earnings. So I think when the market looks at our financial story, it's really trying to assess how much free cash flow we can build over time, and that's really how we think we can build value. As long as we can continue to drive consumers to our products and services, have them spend more time with us, have them spend more money with us over time, we feel like we can drive that revenue per user higher, which will drive revenue and EBITDA and free cash flow very high over the next few years.
Good to have you with us. We appreciate it. Susan Decker, Chief Financial Officer of Yahoo, from her company's headquarters in Sunnyvale, California.